and welcome to the strategic analysis video of the MCS pre-scene video series. Now essentially what we're going to do in this video is go through some of the key business models that you'll be expected to use in the exam and also tie the whole video series together, the whole pre-scene together. So we'll start by a brief introduction to the case. It's on the IT services industry. Now this is something that we may be familiar with in terms of we use the services that IT service companies provide, but we're not really aware of the actual ins and outs and the logistics of it. So of course we know that the company is ABC and they are a successful company operating in Cayland, and from what it seems they have large revenues and a loyal customer base. They also have 5 primary business functions ranging from data storage to integration services. So let's take a look at the case then. Now what we're going to do is analyze the case with the rational business model. Now essentially the rational business model is looking at where you currently are using models such as the PESA analysis, 5 forces analysis, and internal analysis, and production and service analysis. And then also looking at where you want to go, what it is you want to achieve in the future. And the final stage is looking at what you need to get there, where you are now, where you want to be, and what you need to get from A to B. So we'll start by looking at where we want to be. Where does ABC want to be? And we'll do this by looking at models such as the governance model and ethics model and also stakeholder mapping. Now the first one we're going to talk about here is mission statements. So why does the company exist? What does it exist for? What is it trying to achieve? And these questions should all be answered in what they call a mission statement. So this is the statement that is the first thing investors, the first thing that potential clients look at when they want to contract with your organization. It also keeps directors and staff focused on what the overall goal is for the organization. What does it want to achieve in the long run? Now we weren't given any information about mission statements in the pre-scene. And so what it could be is that you are being asked a question in the exam about the value of a mission statement and possible mission statements that ABC could have. So we'll look at the 4 elements of good mission statements. So we'll start off by looking at purpose. Who does the organization exist for? Why does the organization exist? Now some information on the first page of the pre-scene about this, about how the organization was to provide effective IT services for clients. Initially it was started with many other companies as a company to help combat the Y2K virus and the effect that it could have on large organizations' IT systems. It then diversified after the Y2K issue to become a provider of more generic services, a more range of services that many organizations would find useful. So a mission statement based on this purpose could be something along the lines of to be the leading provider of IT services. Something very simple, but it sets out a clear goal. We want to be the leading company. So perhaps you would then look at where you are now. Who are the leaders? Are ABC the leader? If so, how do we maintain that leadership? If not, how do we achieve that leadership? Now the next stage is strategy. So how will the organization compete? Will we compete by providing a unique service that no one can offer? Will we compete by providing the cheapest service on offer? So that would not necessarily be one that is necessarily different or better than anyone else's, but we just do it for a cheaper price. Now values is more to do with what your organization stands for. So I've listed a few examples here: quality, value for money, and innovation. Do we strive to be the most innovative company? Do we strive to give the best quality? Now, some information in the pre-scene does lead to this. On the first page it mentioned about the strategy of hiring the best possible people for the job and paying them well, or rewarding them well. So what we can read from this is that they do have a clear value strategy of hiring the best possible people for the job. So perhaps providing the best quality, which in turn could lead into the best value for money, or in fact the most innovative services. And finally, policies. So what are people expected to do? What are employees expected to do to help the company achieve its mission statement? And of course, this could be, as I've mentioned here, some defined values, and evidence of this can be seen perhaps with Andrew, where he talked about always, or the presentation talked about him always trying to give the customer what they needed the most, even if this meant putting in a cheaper system, or even if this meant trying to convince them to get a more expensive system. It was all to do with providing the client with the best possible service, what was best for them. So that now ties into what the company wants to achieve. It wants to provide the best service possible. Not just necessarily what the client wants, but what they need. Assessing the client's needs and providing them with the best possible solution. Now, a lot of mission statements are used throughout strategy planning. When a new strategy or a new project or a new development is being analyzed and decided upon, they will often look at it in relation to the mission statement. Will this new strategy help us achieve our goal? And one of the ways in which this is also installed in employees is, if you've ever been to a large organization, I'm not sure, many of you may even work in large organizations, but sometimes above the reception desk when you first enter the office is a huge mission statement, a huge stretch of text on the wall portraying the mission statement of the company. And this is indicative of how important companies value their mission statements and how important they are to install these upon staff. Now the next is objectives and performance measurement. So this is, once you've defined your mission statement, how well do you track your progress in achieving that mission statement? Now we weren't given many targets in the case study other than some statements relating to hiring the best people, some statements relating to good business practices of always trying to help the customer achieve what they want. We also heard about the importance of maintaining good relationships with clients. That was one of the key critical success factors that came out of our analysis, was that the company values maintaining good relationships. There was even a section in Andrew's blog post which talked about how he was meeting with a client, and though they weren't able to meet to discuss a big contract that was lucrative, that had a significant revenue gain for the company, he spoke about the goodwill that the meeting generated, the goodwill that the contract generated. And so this is why I feel the balanced scorecard would be an effective measurement of performance for this company. Now, the thing about a balanced scorecard is it plays on the understanding that financial performance isn't the only measure of a good company. A lot of companies, particularly older companies, particularly in older times as such, often found that they only valued financial performance. As long as the company was making money, as long as the shareholders were making money, that was okay. But of course nowadays we have a more broader, more diversified range of performance measurements. So this could be how well we retain our customers, the satisfaction of our staff, the quality of our budget planning, all these sort of things that are not necessarily related to the pure revenue that's generated, but they are all indicators of how well the business is doing. So now we'll move on to governance. Now, as I put here, Governance is the way that organizations are administered, the way that they are controlled. Now, it's worth noting that this is mainly for UK companies and it's for listed companies as well. So as ABC operates in Cayland, you could argue that they are not necessarily bound to act under the UK Code of Corporate Governance. However, that's not to say that we couldn't learn things from the UK Code of Governance that would benefit the company. And so what governance really is, it's all about doing what is best for all your stakeholders. In particular, your shareholders, not exclusively limited to your shareholders. And this, of course, is to attempt to combat the agency problem, which is where the shareholders are owners of the organisation and the directors are running the organisation on the shareholders' behalf. But of course, directors are employees. They want to do well in their job. They want to be paid well. They're being paid a lot of money, and sometimes a lot of their bonuses and their salaries are based on the short-term performance of the company. Whereas, of course, shareholders as owners want long-term sustainable growth and survival of the company. And so the issue you have is sometimes directors will leverage long-term success in return for short-term gains so that they get their bonuses, they get their salaries, and then they can just move on and the company is left in the lurch, as it were. So here are a few principles of good governance. So you need a separate chairman and CEO. So obviously the chairman is the head of the board and the CEO is the head of the company. So the CEO's job is to take the strategy that the board has defined and apply that to the day-to-day running of the company. So if you have the same persons being the chairman and the CEO, you have someone who designs the strategy and implements the strategy. And of course, if that was the case, you'd probably find someone who sets quite low targets they know they will be able to achieve. The next is independent non-executive directors. So these are people who are impartial. They are not employed by the company, but they are put on the board to ensure that the executive directors, the people who are employed by the company, are doing their job properly and nothing untoward is happening, no conflicts of interest are arising. And part of this is by having audit, nomination and remuneration committees. So the audit committee is populated by non-executive directors who assess the running of the company. They assess the board to check that nothing wrong is happening, that the right procedures are being followed. The nomination committee is to do with electing people to be executive directors. And a problem with this is that a lot of the time, particularly if it's a family-owned company, they will often try and put family members on the board to keep it all within the family, so to speak, to bring in more salaries to the family. And so the nomination committee is there to check that everyone who is put on the board, everyone who is elected to the board, is of a suitable standard for the role. They have the necessary skills and experience. And remuneration committees, as it sounds, is to do with the director remuneration. So obviously the executive directors can't be in charge of their own pay because they'll just give themselves huge salaries. So the non-executive directors assess the performance of the board, assess the performance of the individual directors and the company itself, and decide on a fair remuneration package. Also, the non-executive directors are there to ensure that there is a focus on risk management. Now, risk is a big CIMA topic, used at P1, P2 and P3 level. And essentially it's to do with ensuring that the directors are looking at potential risk and taking steps to mitigate them. Now, disclosures of directors' pay, this is to do with publishing accounts. How often have you watched the television and there's been some uproar about a listed company who have paid their directors $16 million even though the company did poorly? This is because by corporate governance they are bound to release this information to stop, in a sense, directors from being paid more than everyone feels they should be paid. Also, another part of corporate governance is to ensure that the correct financial reporting is done, so that the finances are reported in the exact same way every time. This means they are consistent so that investors, so that shareholders can look at them, and also so that they can ensure that the right information is passed on to the relevant auditing firms to check that all relevant tax has been paid and that all accounting standards have been accounted for. And the last few things here talk about making sure the right directors are involved in decision making, that all directors are involved and they have the right information. And finally, good use of the annual general meeting. So this is the once a year event where all shareholders of the company can go. It's imperative that companies have these and that they use the information or use the opinions and the statements that many shareholders have made during this meeting. So how has ABC applied corporate governance? Well, to be fair, it was quite poor. Under good corporate governance, you should have a board of 12 people and a chairman. You should have 6 executive directors and 6 non-executive directors. ABC only had 2 non-executive directors, and that included the chairman. Now, admittedly, he was an independent and non-executive chairman, experienced, right for the role, but there was questionable independence there. Now, although he technically is independent, he was the CEO of the company the founders initially worked for, so they have a pre-existing relationship. It could have been that the founders brought him on as the chairman because they knew he would be a nominal chairman in a sense and just do what they said. On that note of nominal, it also mentioned in the pre-scene that Andrew, who was the CEO, was a nominal CEO. Now this is poor corporate governance in itself, because the CEO's job is to run the business on the day-to-day. And yet he was more concerned with going about his normal business before he was a director, with getting involved in the lower level operations of the organisation, which of course is not what a CEO should be doing. Also, there was no mention of these audit, remuneration and nomination committees. Now, it was stressed on the previous slide the importance of these 3 committees, and they need to be staffed by 2 to 3 non-executive directors, so they don't even have enough staff on the board to populate these committees, so that's very poor governance. And some other information here that is interesting are other things from that list of good corporate governance practices that we have no evidence of in the pre-scene. Now, this is not necessarily because they don't do them, they just haven't mentioned them. And that was disclosures of directors' pay in the financial statements. There was no talk about directors' salaries in that. We don't know how much information they are given, and there was no information about institutional shareholders. So your institutional shareholders are your big shareholders, so your investment banks and your pension funds and things like that. There was no information about whether the company has them, and if so, do they have any meetings with them? And of course, no mention of the annual general meeting either.